Have you ever wondered why central banks around the world are buying physical gold at the fastest pace since 1967? Not gold stocks, not gold ETFs, but actual physical gold. The kind you can hold in your hand. There's a reason for that, and it's the same reason why you might be putting yourself at serious risk if you're holding gold stocks instead of physical gold right now. Let me show you what's really happening behind the scenes. In the first quarter of this year alone, central banks added 228 tons of physical gold to their reserves. That's a 34% increase from the previous year. Countries like China, Russia, Turkey, and even Poland are aggressively accumulating physical gold. Not paper gold, not gold mining stocks, physical gold. Now, why would they do that? These are sophisticated financial institutions with access to the best investment vehicles in the world. They could easily buy shares in Barrick Gold or Newmont Mining. They could purchase gold ETFs with a single phone call. But they're not. They're going through the considerable trouble of acquiring, transporting, and storing physical gold. They know something that many retail investors don't. When you own shares in a gold mining company, what you actually own is a piece of a business that happens to mine gold. You don't own gold. You own a business with management teams, operational risks, debt obligations, and countless other variables that have nothing to do with the price of gold itself. Let me give you a real-world example of how this can go terribly wrong. Back in 2013, when gold prices fell sharply, many investors thought buying gold mining stocks at a discount was a smart move. After all, the companies were still producing gold, just at a lower profit margin. But what happened next shocked many investors. Companies like Allied Nevada Gold Corp., which was once worth over $5 billion, filed for bankruptcy by 2015. Shareholders were completely wiped out. The gold in the ground was still there. The price of gold eventually recovered. But the shareholders? They lost everything. This isn't an isolated incident. During market stress, the correlation between gold stocks and physical gold often breaks down completely. In March 2020, when COVID hit, physical gold dropped about 12%. But gold mining stocks, as measured by the GDX ETF, crashed by over 40%. That's more than 3 times the drawdown of the physical metal. Now, let's talk about counterparty risk, a concept that becomes extremely important during times of financial stress. When you own physical gold, there is no counterparty risk. It's yours. You possess it. Its value doesn't depend on anyone else fulfilling their obligations to you. But with gold stocks, you have multiple layers of counterparty risk. You're depending on the mining company to operate profitably. You're depending on the management team to make good decisions. You're depending on the political stability of the countries where the mines are located. You're depending on the brokerage where you hold your shares to remain solvent. You're depending on the clearing system to function properly. That's a lot of dependencies, a lot of things that can go wrong. In 2008, when Lehman Brothers collapsed, many investors learned the hard way about counterparty risk. People who thought they owned gold through various paper instruments suddenly discovered they were just unsecured creditors standing in line during bankruptcy proceedings. Now, I'm not saying gold stocks don't have their place. They offer leverage to gold prices. When gold goes up 10%, gold stocks might go up 20% or 30%. But that leverage works both ways. And more importantly, that leverage assumes normal market functioning. In a true financial crisis, the very scenario many gold investors are trying to protect against, gold stocks can become untethered from gold prices and start trading based on liquidity needs, margin calls, and broader market panic. Let's look at some historical examples that illustrate this disconnect. During the 1980 gold bull market peak, physical gold hit $850 per ounce. Many gold mining stocks reached all-time highs. But when gold corrected, something interesting happened. While gold pulled back about 45% over the next few years, many mining companies saw their shares decline by 70 to 90%. Some never recovered, despite gold eventually making new highs decades later. More recently, between 2011 and 2015, gold declined about 45% from its peak. During that same period, the GDX Gold Miners ETF collapsed by over 80%. Many individual gold mining companies went bankrupt, or were forced into highly dilutive financing arrangements that destroyed shareholder value. Think about that. Gold declined by less than half, but gold stocks as a group declined by more than 80%. Individual companies fared even worse. Now, let's talk about what's happening in the gold market today that makes physical ownership more important than ever. The gold market has a dirty secret that's rarely discussed in mainstream financial media. The paper gold market, futures contracts, ETFs, unallocated accounts, is vastly larger than the physical gold that backs it. By some estimates, there are over 100 paper gold ounces trading for every physical ounce available for delivery. This creates a precarious situation. It's essentially a fractional reserve system for gold. It works fine under normal conditions. But what happens during a crisis, when too many people want to convert their paper gold to physical gold at once? We got a glimpse of this in March 2020. When COVID hit, there was a massive divergence between paper gold prices in New York and physical gold prices in London. At one point, physical gold in London was trading at a $70 premium to paper gold in New York, on a $1,600 asset. That's more than a 4% spread in what should be the same price. Why? Because people wanted physical delivery, and the system wasn't designed to handle that level of physical demand. The COMEX had to create a new, enhanced delivery mechanism almost overnight. Several major banks faced potential defaults on their gold obligations. The entire paper gold system came under stress. And that was just a taste of what could happen in a more severe financial crisis. Quick aside, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to why central banks are accumulating physical gold at record pace. They understand the difference between owning the real thing and owning a paper promise. Central banks don't buy GLD shares. They don't buy futures contracts. They buy physical gold bars, take delivery, and store them in their own vaults. There's a reason for that. In 2013, when Germany decided to repatriate some of its gold from the Federal Reserve Bank of New York, it took 7 years to complete the transfer. 7 years to move gold that was supposedly already owned by Germany. This raised serious questions about whether the gold was actually there, or if it had been leased out or encumbered in some way. This kind of situation is exactly why physical possession matters. In a crisis, paper promises can be broken, delayed, or renegotiated. Physical gold in your possession cannot. Now, let's talk about another risk of gold stocks that's rarely discussed: nationalization risk. Throughout history, when gold becomes extremely valuable or strategic, governments have shown a willingness to nationalize mining operations. It happened in Venezuela in 2011. It happened in Tanzania in 2017, when they hit mining companies with $190 billion in tax bills. Yes, billion with a B. It's happening right now in Mexico, where the government is restricting new mining concessions. When you own shares in a gold mining company with operations in these countries, you're exposed to this political risk. When you own physical gold, you're not. But perhaps the most compelling reason to own physical gold instead of gold stocks is what's happening with the global monetary system right now. We're witnessing what many experts believe is the early stages of de-dollarization. Countries like Russia, China, India, and Brazil are creating alternative payment systems that bypass the US dollar. They're settling trade in local currencies. They're accumulating gold. The BRICS nations, Brazil, Russia, India, China, and South Africa, have openly discussed creating a new reserve currency backed by a basket of commodities, potentially including gold. If even a small portion of the $23 trillion in global reserves currently held in dollars begins to shift toward gold, the impact on gold prices could be enormous. But here's the key. In such a scenario, governments may restrict the flow of physical gold. They may impose windfall profit taxes on mining companies. They may even nationalize strategic assets. This isn't speculation. It's happened before. In 1933, President Roosevelt signed Executive Order 6102, making it illegal for U.S. citizens to own more than a small amount of gold. The government forced citizens to sell their gold at $20.67 per ounce. Then, after collecting the gold, they revalued it to $35 per ounce, a 69% increase that citizens couldn't participate in. Could something similar happen again? History suggests it's possible. And if it does, owning gold mining stocks won't provide the same protection as owning physical gold that you can keep secure. Now, I'm not suggesting you liquidate all your gold stocks tomorrow. They can be valuable as part of a diversified precious metals strategy. But if you're holding gold stocks instead of physical gold because you think they're equivalent or because they're more convenient, you need to understand the additional risks you're taking. Let's talk about another aspect of gold stocks that makes them fundamentally different from physical gold: operational risk. Mining is an incredibly difficult business. Companies face rising energy costs, labor disputes, environmental challenges, permitting delays, and technical difficulties. A mine that looks profitable on paper can quickly become unprofitable if any of these factors change. For example, in 2017, Acacia Mining, now part of Barrick Gold, saw its shares collapse by over 50% when Tanzania banned the export of gold concentrate. The gold was still in the ground. The gold price was stable. But shareholders suffered massive losses due to a political decision completely unrelated to gold's value as a monetary metal. Or consider Pascua-Lama, a massive gold project on the border of Chile and Argentina. After investing billions of dollars, Barrick Gold had to shelve the project due to environmental concerns, regulatory issues, and cost overruns. Shareholders effectively paid for gold that will never be mined. These operational risks simply don't exist with physical gold. An ounce of gold is an ounce of gold, regardless of who mined it or how difficult it was to extract. There's also the issue of management decisions. Mining company executives don't always act in the best interest of shareholders or with a proper understanding of gold's monetary role. During the last gold bull market from 2008 to 2011, many mining companies used their inflated share prices to make expensive acquisitions. They overpaid for assets, took on too much debt, and expanded production at the peak of the cycle. When gold prices corrected, these companies were left with impaired balance sheets and had to dilute shareholders through equity raises at much lower prices. This kind of value destruction doesn't happen with physical gold. Gold doesn't make bad business decisions. It doesn't take on debt. It doesn't dilute itself. Now, let's address another critical difference. Gold stocks are financial assets that exist within the financial system. Physical gold exists outside of it. In a severe financial crisis, trading in stocks can be halted. Brokerage accounts can be frozen. Bankruptcy proceedings can tie up assets for years. The entire electronic trading infrastructure relies on functioning electricity grids, internet connections, and banking systems. Physical gold requires none of that. It can be exchanged directly between parties without any financial intermediary. It has served this function for thousands of years across countless civilizations and through every type of crisis imaginable. This is why gold has been the ultimate form of wealth insurance throughout history. Not gold stocks, physical gold. Consider what happened in Cyprus in 2013. When their banking system collapsed, the government imposed a bail-in, forcing large depositors to take losses of up to 60%. People who thought their money was safely deposited in banks suddenly found their accounts frozen and their savings partially confiscated. During this crisis, physical gold held outside the banking system was completely unaffected. It couldn't be bailed in. It couldn't be frozen. Its value actually increased as people lost faith in the financial system. Gold stocks, being part of that same financial system, would have been subject to the same trading halts and potential restrictions. This brings us to perhaps the most important point: the purpose of gold in a portfolio. If you're buying gold as a speculative investment, hoping to make a quick profit on price movements, then perhaps gold stocks make sense for a portion of your allocation. Their leverage to gold prices can amplify returns in a bull market. But if you're buying gold as wealth insurance, as protection against currency devaluation, financial instability, or systemic risk, then physical gold is the only logical choice. That's because the very scenarios you're insuring against are the ones where gold stocks are most likely to become disconnected from physical gold. It's like buying flood insurance that only pays out if there's no flooding in your area. It defeats the entire purpose. Now, I understand the convenience factor of gold stocks. They're easy to buy and sell. They don't require secure storage. They can be held in retirement accounts without special arrangements. But convenience should never be confused with security, especially when it comes to wealth preservation. And speaking of retirement accounts, this is where many investors make a critical mistake. They hold paper gold or gold stocks in their IRAs, thinking they've protected their retirement from currency devaluation or financial instability. But they've actually introduced multiple layers of counterparty risk into what should be their most secure assets. A properly structured gold IRA allows you to hold physical, segregated gold in a secure vault, within the tax-advantaged structure of an IRA. It combines the security of physical gold with the tax benefits of an IRA. But most investors aren't aware this option exists, so they default to gold stocks or ETFs in their retirement accounts. Let's also address the dividend argument. Some investors prefer gold stocks because certain mining companies pay dividends, whereas physical gold does not generate income. This is a valid consideration, but it needs to be weighed against the additional risks. Those dividends are not guaranteed. During the 2013-2015 gold bear market, many formerly reliable dividend-paying gold miners were forced to reduce or eliminate their dividends entirely. Some never restored them, even after gold prices recovered. Physical gold doesn't pay dividends, but it also doesn't cut dividends. Its value proposition is different. It's about preservation rather than income. Now, let's talk about what's happening with institutional investors and gold right now, because it's quite revealing. Major institutional investors like Ray Dalio's Bridgewater Associates, Stanley Druckenmiller, and Paul Tudor Jones have all increased their gold allocations in recent years. But if you look at their 13F filings, you'll notice something interesting. Many of them hold physical gold through trusts like PHYS, Sprott Physical Gold Trust, that are fully backed by allocated physical gold, rather than traditional gold ETFs like GLD that have more complex structures. They also tend to hold senior gold miners with strong balance sheets as a supplement to, not a replacement for, physical gold exposure. These sophisticated investors understand the difference between gold as money and gold mining as a business. They allocate accordingly. So what should you do if you currently own gold stocks instead of physical gold? First, understand what you actually own. Gold stocks are businesses that mine gold. They are not gold. Their performance will sometimes correlate with gold prices, but that correlation can break down precisely when you most need it to hold. Second, consider your purpose for owning gold. If it's for wealth insurance against systemic risk, physical gold should form the foundation of your precious metals allocation. Gold stocks, if used at all, should be a satellite position for potential additional upside. Third, if you're going to own gold stocks, focus on quality. Companies with low debt, operations in stable jurisdictions, experienced management teams, and a history of respecting shareholder capital tend to outperform over full market cycles. Fourth, understand that proper diversification isn't just about having different assets. It's about having assets with different risk profiles. Physical gold and gold stocks have very different risk profiles, despite both being related to gold. Finally, consider the current global monetary situation. We're living through unprecedented times. Global debt has reached over $300 trillion. Central banks have expanded their balance sheets to levels never seen before. Geopolitical tensions are rising. De-dollarization efforts are accelerating. In this environment, the case for physical gold ownership is stronger than ever. Not as a speculation, but as a form of financial insurance against the unknown. Central banks understand this. That's why they're buying physical gold at the fastest pace in over 50 years. They're not buying gold mining stocks. They're buying the real thing. Perhaps it's time more individual investors followed their lead, because when the next financial crisis hits, and history suggests it's a matter of when, not if, the difference between owning physical gold and owning gold stocks could be the difference between preserving your wealth and losing a significant portion of it. The choice is yours. But now, at least, you understand the risks.